Hello everyone, this is Sebastian McMahon from IA Financial Group. I'm back with another edition of the weekly economic review, this time for the week ending October 7th, 2022. Let's start with the market. So green for equities, red for bonds, so interest rates higher on the week, meaning that you have losses on a bond portfolio. For equities, strong gains after 4 days, but as I am recording this on Friday morning prior to market open, we're headed towards a down day. Probably will stay in positive territory on the week, but the returns could be a bit smaller than what you see here. We're down about 1% on all of the major markets because of the data coming out from the labor market that were a bit stronger than expected. So more on that in a minute. Price of oil up more than 11% on the week because of the cuts in production from OPEC. And if you remember, recently prices of oil were high. The US decided to draw from its strategic reserves to keep prices lower. It worked, pushed prices down. Now OPEC is cutting production to raise prices. So you see where we are, kind of in a tug of war, which could lead to some geopolitical tensions. So the net result is up on the week, but let's see where we go from here. Price of the Canadian dollar was up on the week, 0.6%. Price of gold going nowhere, some volatility, 3% higher this week. So looking at the data, so this morning we had the job gains in both the US and Canada. So not much of a story, but there was some optimism that was starting to appear through investors in the markets. Some were starting to think that, well, if the labor market starts to cool down, maybe that means that there are fewer rate hikes coming and a pivot is coming. So the optimism was in the markets this week, and it's deflating this morning because there were more jobs created in the US than what was expected. So that's the only story there. When we look at the data, there's not much to change the Fed's view or to change our reading on the US economy. So it's still a very strong labor market. So that's for the US. In Canada, the story is that we have gains for the first time in 4 months. So the previous 3 months were negative. A total of 113,000 jobs were lost in the previous 3 months. Now we have a gain this month. So good news for the Canadian economy here. Looking more globally, so the global economic cycle is starting to slide slowly into recession territory, and a global recession doesn't mean a contraction of global GDP, it's just growth that is slower than 2.5 or 3%. This is typically what we consider a global recession, but the global PMI index slid below 50 for the first time since of course the worst of COVID. And as you can see, the red line, our leading indicator related to monetary policy, is pointing towards more weakness going into 2023. So just reminding you of the big picture here. Focusing maybe on the Canadian economy, the housing market, we'll be discussing that in a lot of details over the coming months, but let's take a look right now. So Canada's economy has become quite sensitive to interest rates. We're starting to see a slowdown in the number of transactions on the left, and of course in prices on the right. So on the left you have the volume of transactions, so the number of transactions in Toronto and in Vancouver. So you have the two most busy markets, let's say. So in both cases the number of transactions are falling. Prices are also falling in most of the main cities in the country, but of course after a rise of 50% during the pandemic for the price of the average house in Canada, it's normal to see a pullback. It's normal to see activity slow down, and with rates rising by 3% already this year and more to come, it's of course we were going to be seeing fall in prices and fall in the number of transactions. That leads us to the housing market now already being in the worst drawdown in 13 years. So we're down more than 4% from the peak. Where will we go? It's still up in the air, but expect a strong drawdown, and it's worse than what we saw in 2016 to 2018, but it's still pale in comparison to what we saw in 2008. So it's normal to see that. You want to see something like that because you don't want to see bubbles, blowing up at some point. So it's a return to normal. But it's very important to understand that the Canadian economy is very sensitive to interest rates now, and what happens in housing could be enough to lead the Canadian economy into a recession. Because, as I said, Canada's economy is very sensitive to interest rates because the share of residential investment as a percentage of GDP, it's close to 10% in Canada, which is twice the size of the same sector in the US. And when you break down all three components, of course, there's construction and demography. Demographic growth in Canada is very strong, so more construction is needed to accommodate for the rise in the number of households. Renovation higher, but also in both of these cases, low interest rates meant that more spending on housing. Rising prices meant that there was some speculation, and also with with interest rates being extremely low, the cost of, or let's say the affordability of housing was very high. So that means that there was lots of demand for housing. The red part is the ownership transfer cost. So this is linked to the number of transactions and the average price of every transaction. So it's all of the fees that are related to the transactions about when someone buys a house from someone else. And you see the spike that we saw recently. This is as a percentage of GDP. The average long-term value of that is somewhere around 1%. Over the last few years before COVID, it was more 1.5%. But if we just go back to this long-term average, there's 1.5 to 2% of GDP that could just evaporate just from the fact that there's fewer transactions on the housing market and that the average price falls down. So this is a real risk for the recession call. So yes, the labor market in Canada is strong. Yes, our trade sector is doing pretty well, but housing, of course, this is the main risk factor, and that's why we're focusing on that, and we'll be focusing on that more and more as we move through the coming months and quarters. So what to watch next week? Manufacturing sales and existing home sales in Canada. So we'll have some reading on housing. In the US, the Small Business Optimism Index, the CPI inflation numbers. Remember that last month when we had the CPI numbers come out in the US, on that day we had the fall of 4.5% of the S&P 500 because inflation was a bit stickier than expected. So it is a market mover. So next week we'll have the new reading, and retail sales should be out and positive in September. So that wraps it up for the week. ia.ca/economy is your go-to webpage. You can subscribe to the newsletter if you haven't done so already. The In Your Interest podcast, we're going to be entering in the studio next Tuesday to record some new materials. So stay tuned. Economy and Finance 101, social media. There's a lot for everyone out there. So feel free to follow us. So that wraps it up for the week. See you next week, and we wish you a very nice long weekend.